New Mexico Real Estate Principles Workbook, page 50. 4. Leverage. 5. Management. 6. Tax impact. 7. Return yield. 8. Risk. I. Real estate cash flow model. On top is the potential gross income minus vacancy and bad debt equals effective gross income minus operating expenses equals net operating income minus debt service equals cash flow before tax minus or plus tax liability or tax savings equals after tax cash flow. J. Cash flows generated by investment real estate. 1. Initial investment. A. Down payment and acquisition costs. B. A negative cash flow, money out. 2. Periodic cash flows. A. Annual after-tax cash flow. B. Typically positive, but may be either periodically or consistently negative. 3. Sale proceeds. A. Typically positive, money in. B. For analysis, add to the final year cash flow from operations. Page 51. K. Income taxes. With federal income tax rules, we sometimes have to have various options regarding a particular tax liability. We may pay it now or perhaps later. We may not pay it either legally or illegally. These options give rise to the following. 1. Tax deferral. A. Tax obligations that the rules allow us to legitimately defer or postpone to a future time. 2. Tax avoidance. A tax obligation that can be legally avoided altogether, never paid, because of special allowances in the tax rules. 3. Tax evasion. A. Failing to pay a tax obligation that is neither deferred nor legally avoided. L. Individual taxable income categories. Under the Tax Reform Act of 1986, subsequent revisions, the Internal Revenue Code, IRC, defined 3 specific categories of individual income subject to taxation. Different rules and limitations apply to each of these categories. 1. Earned income. A. This is the income generated by salaries, wages, and self-employment, such as a real estate agent's commission income. Earned income is taxed as ordinary income at the individual's appropriate tax rate. 2. Portfolio income. A. This involves interest, dividends, and investment gain or loss. Portfolio income is included in adjusted gross income by calculating the net result of gains and losses on short-term and long-term investments separately. Portfolio losses may be used to reduce the total liability for income taxes, but only within certain limits. 3. Passive income. A. This is income from the conduct of any trade or business in which the taxpayer does not materially participate. Rental activities are defined as passive activities. The ownership and rental of real property is generally a passive activity. A limited partner in a limited partnership is definitely a passive activity. Net income from a passive activity is taxable as ordinary income. The reason for defining this category of income in the tax code was to segregate losses from passive activities. Generally, all passive losses may only be used to offset income from passive activities. A net passive loss may not be used to shelter other categories of income. 1. There is an exception to the passive activity rules for rental real estate in which the taxpayer actively participates. There are complex rules defining the term active.